So we have illustration here that prepare the closing entries from the following selected accounts from records of Westmont Service Corporation at the end of December 31st, 2014. So I just want you to pause the video here and try to solve it by yourself. Then we're going to see its solution together. Again, let's see it together. So first of all, we are closing down the revenue accounts. So what is the entry for the revenue closing of the revenue account? So remember, it is the reverse entry when the revenue is created. So when revenue is created, revenue is credited, but when you close down, revenue is debited against the retained earnings. So point out what are the revenue. Revenues are service revenue and interest revenue. We don't see any revenue here except these two. So we have entry would be service revenue, interest revenue to retained earnings. So where does 64,600 came from? You add these two amounts are equal. So there is a rule that debits must be equal to credit here. So the entry is balance out, right? And now closing of the expense account. When expense accounts are created, they are debited, but now we are closing down, so we have to make reverse entry against the retained earning. So expense would be credited. So entry would be retained earnings to all expenses. Cost of goods sold, we have the expense. Do we have the accumulated depreciation? No, because accumulated depreciation is the addition of all the depreciation expense. So we just have to include depreciation expense, not the accumulated depreciation. And then selling, general and admin expenses, and then income tax expense. So retained earning to cost of goods sold, to selling and general admin expenses, to depreciation expense, to income tax expense. So where this 50,800 came from? You add all these, answer would be 50,800. So now closing of the dividend. How much dividend we have? We only have one dividend account here. So when you close down the dividend, entry would be the reverse of when we created. So when dividend increase, dividend are debited. But when you close it down to the revenue, to the retained earnings, answer would be retained earning to dividend 600. Right? So how much net income is that? Total revenue minus total expenses. So total revenue is this one, and total expenses against, we have depreciation expense. Let me just change the color here. We have depreciation expense, we have income tax expense, we have cost of goods sold, accumulated depreciation, no, selling and general expenses. So answer would be 64,600 minus 50,800. Answer would be 13,800, right? And this is how we calculate the net income. So preparing for the T accounts. So we know that expenses are so retained earning is debited with expenses and dividend, and credited with revenues. So that's how the retained earning balance came from here. So that is the beginning balance and that is the ending balance, right? Where this beginning balance came from previous year balance. Okay, let's move further to classify assets and liabilities based on the liquidity. Liquidity means how fast or easily an asset can be converted into cash. So cash is the most liquid item. After that, accounts receivable are relatively liquid because cash collections usually follow quickly, like in 1 month or 2 months or 3 months. And after that, inventory, which is less liquid than accounts receivable and cash, because in order to liquidate that one, inventory must be sold. And then comes the equipment and building, which are even less liquid because these assets are not for sale, and if we put them for sale, it takes more time than inventory, accounts receivable and cash. And then assets and liabilities are presented in order of liquidity. So the most liquid assets, they come first. So first of all, we write down the current assets and then we write down the long-term assets. On the liability side, we write down first the current liabilities and then we write down the long-term liabilities. What do we mean by the long-term assets? Whose benefit is for more than 12 months or for more than 1 year. So these are land, building, furniture, fixture, equipment, and plant. And intangible assets are patents, investments, right? What are the current liabilities? Whose life is less than 1 year or within the operating cycle or accounting cycle. So these include account payable, notes payable, salary payable, unearned revenue, interest payable, tax payable, right? In the long